Dear learners, welcome to this session. Today we will be understanding the next topic of accounting ratios, that is solvency ratios. Broadly, there are four types of solvency ratios. The basic objective of calculating solvency ratio is to understand long-term financial position of a business. Under this, first category is debt equity ratio, and its formula is quite simple: long-term debts divided by equity. Long-term debts include debentures, bank loan, mortgage loan or public deposits, whereas shareholders fund, also known as equity, includes equity capital, preferential capital and all the reserves and surplus. The ideally accepted ratio for debt equity is 2:1. The significance of calculating debt equity ratio is to understand that how many long-term debts are supported by the owner's fund. Second type of ratio is proprietary ratio. In this, formula is equity, which we have already discussed in the first formula, divided by total assets. The basic purpose of proprietary ratio is to understand that how many shareholders fund is supported and backed by the total assets. Moving on, third type of solvency ratio is total assets to debt ratio. The formula for it is simple: total assets divided by long-term debts. Finally, these three ratios are always calculated in the form of absolute ratio. Moving on to the last category, that is interest coverage ratio. Formula for interest coverage ratio is EBIT, that is called as earnings or net profit before interest and tax, divided by fixed interest. And keep in mind, this ratio is always in the terms of times. Its answer will always be given in times, whereas this three, its answer would be in the terms of absolute ratio. Interest coverage ratio helps to understand the investors that how much or how many times the interest is secured or covered by the profits. Higher the better it is, but 6 to 7 times is considered as an ideal ratio. Let's understand them with the help of an example. First example is calculate debt equity ratio, proprietary ratio and total assets to debt ratio. We will find first three ratios using this data. To solve, first one by one we have to label the information provided. First, to calculate debt equity ratio, proprietary and total assets, if we will look at the formula, we need the long-term debts value, we need equity fund and we need to know about total assets. So only these three terms are used in this three formulae. Let's calculate their values. First is long-term debts. They are also known as borrowed funds. They are also known as non-current liabilities. For this, long-term borrowings and long-term provisions, 1,20,000 plus 30,000, 1,20,000 plus 30,000. This includes two items, long-term borrowings and long-term provisions. So this answer is 1,50,000. Next, we need to find equity, that is shareholders fund. Equity is also known as shareholder fund. Equity includes equity share capital and reserves, 2,80,000 plus 20,000. 2,80,000 plus 20,000. This term which we need is total of assets. Total assets can be calculated either through liability approach or through assets approach. We have here non-current assets and current assets. The total of non-current plus current assets is equal to total assets. 3,80,000 plus 2,20,000. This is equal to 6 lakh. So these are the three titles. Substituted one by one. First ratio is debt equity ratio. Debt equity ratio. This is equal to long term debts divided by equity. Our long term debts are 1,50,000. 1,50,000 divided by 3 lakh. So this is 1 upon 2. We need to get the answer of denominator in absolute 1. So therefore debt equity ratio is 0.5:1. Our ideal ratio is 2:1. In this situation, lower the ratio, financial position is strong. Means higher ratio is not considered good. Lower the ratio, that means the borrowed funds or external investors, they feel more secure. Second, we need to find proprietary ratio. So our proprietary ratio formula is equity upon total assets. Equity divided by total assets. By substituting the value, equity is 3 lakh and total assets are 6 lakh. 3 lakh divided by 6 lakh is equal to again 1 upon 2. That is 0.5:1. This is also satisfactory situation. Finally, we have to calculate total assets to debt ratio. Total assets to debts. Formula is total assets upon long term debts. Our total assets are equal to 6 lakh divided by long term debts, it is 1,50,000. This gives us 4:1, which is again a satisfactory and good situation for the business, because the total assets are 4 times more than external funds or borrowed funds. Second category, calculate debt equity ratio, and we are given with the information total assets, current liabilities, total debts is 2,90,000. To proceed with this, first we have to find debt equity. Our formula is debt equity ratio. Apply the formula. Formula is long term debts upon equity. From the given information, let us calculate the long term debts. It is not given to us, as well as equity value is also missing. So this is a tricky sum, a hot order. In order to find long term debts and equity from this hidden information, we need this type of formula. Here it is mentioned, keep in mind that total debts are always equal to non-current liabilities plus current liabilities. Balance sheet A, liability side pay, first head is always for shareholder fund, second head is about which is not to be treated, third head is long-term borrowings, that is non-current liabilities, fourth head is current liabilities. So non-current liabilities plus current liabilities are equal to total debts. Further, total assets, we know that balance sheet assets are equal to liabilities. So total assets are always equal to total liabilities. Just now I said the total liabilities is sum total of equity plus total debts. So we will use these two equations to find the values here. First of all, you have total debts. In question we are given total debts. So total debt is equal to non-current liability plus current liabilities. Substitute the values. Total debts are 2,90,000. Non-current means long-term debts. This is what we want here. Plus current liabilities are given 40,000. 40,000. So substituting the size, we will find the answer of long-term debt 2,90,000 minus 40 is equal to 2,50,000. Now next term is to find equity. For equity, we have to apply again this formula, that is total asset is equal to total liabilities. Total assets are equal to total liabilities. Total assets is equal to total liabilities, and total liability is equal to equity plus long-term debts. Long-term debts value, now we know it is 2,50,000. Total liabilities is equal to total assets, so this will give equity is equal to 7,90,000 minus long-term debts. Our long-term debts are 2,50,000. Total debts, it's not long-term debts, it will be total debts. Total debt, and total debt value is 2,90,000. 2,90,000. From here we will get 5 lakhs. Substitute the value in the formula and you are done. Let equity ratio is equal to long-term debts. We got this answer 2,50,000. 2,50,000. It is to be divided by equity, that is 5 lakh, and this gives us again 1/2, that is 0.5:1, which is a satisfactory situation. Financial position is good. Lower the ratio, better it is. Next category is debt equity ratio is given to us, and using these transactions we have to find out whether our debt equity ratio will improve, decline or remain constant. अगर business की debt equity ratio है 1:2 और in 3 different situations के under whether our equations due to these transactions our debt equity improves or declines or it remains constant. Understand it one on one. Situation 1, if I convert it into a formula, debt equity ratio is equal to long-term debts divided by equity. Ratio is given to me 1:2. I assume it that let my long-term debts are equal to 1 lakh and my equity is equal to 2 lakh. This is to maintain my ratio. If I divide 1 lakh by 2 lakh, I am again getting my answer as 1:2. Now, see what happens in situation 1. It is repayment bank loan rupees 50,000. When we will repay bank loan, first of all bank loan is our long term debt. तो जब आप बैंक लोन पे करेंगे तो आपकी लाइबिलिटी लॉन्ग टर्म रिड्यूस होगी एंड साइमल्टेनियसली कैश और बैंक whatever it is a current asset will reduce. अब इस रेशियो का इम्पैक्ट आपके डिनोमिनेटर पे नहीं आ रहा, डिनोमिनेटर remains same because there is no change in equity. Your long term liability is reducing क्योंकि आप बैंक का लोन वापस कर रहे हैं and simultaneously your bank balance which is current asset is also reducing. Here we do not have current asset, we have only long term debts. 50,000 की पेमेंट करने के बाद ड्यू टू फर्स्ट सिचुएशन our debt long term debts will reduce by 50,000. So 1 lakh minus 50,000, we are left with 50,000. Then when this 50,000, denominator remains same, 2 lakh. So what is the result from here? It will become 1 upon 4, that is 0.25. 0.25 ratio 1. Whereas earlier the ratio was 1:2. Now ratio is 1.25 ratio 1. Means it is further reduced, which is a positive situation. Second case, 1 upon 2 is 0.5. Earlier it was 0.5:1. Now it is 0.25:1. So ratio has declined, but situation is better. Case 2. In second situation, equity shares are issued for rupees 1 lakh. जब आप equity shares issue करेंगे, तो equity share is a part of equity capital. हमारी capital increase होगी और bank balance increase होगा. Bank is a part of current asset, वो इस ratio में नहीं use हो रहा. So no change on the. In this situation, numerator is not changing because there is no information about the debts, long-term debt. Equity share is a part of denominator. Equity share issue करने से हमारी equity capital increase होगी. What happened in this? With 1 lakh, denominator will increase, numerator will remain unchanged. Now there is no change in the numerator. हमारे long-term debt same है, but our equity actually was 2 lakh. 1 lakh के हमने share issue कर दिए. Equity has increased, it becomes 3 lakh, and with this our revised ratio 1 upon 3 will become 0.33, or here you can consider it 1:4, or in this situation 0.33:1. So what happened? Ratio has declined, but it is still a better situation. Third situation, in third case, goods purchased rupees 10,000. Goods जब हम purchase करते हैं, it becomes inventory, and inventory is current asset. Goods purchase की, current assets, inventory increase हुई. और आपने cash पे purchase की हैं, तो other current asset, cash और bank has decreased. तो ultimately दोनों इस items का impact current assets पे है. So there is no impact on the long-term debts or on equity. Therefore, no change. There is no change. It will remain same as it is. Moving on to the last and important category, that is about interest coverage ratio. For this sum, we have been given net profit after tax. 12% debentures, tax rate is 40%. What we need to calculate is interest coverage ratio. Formula for interest coverage ratio is EBIT. EBIT means tax और interest pay करने से पहले वाला profit. Means the profit which was before paying interest and tax divided by fixed interest. Remember, this answer will be in terms of times. Now let's start. The profit which is given to us in the question is given after tax, but we want to go back, and in this profit, net profit after tax, इसमें से tax भी minus है and इसमें से interest भी minus है. Therefore, we have to add back interest also as well as tax in this to arrive at EBIT. So let's do that. First of all, we will calculate the profits before taxes. Here it is given that tax rate is 40%. Means if out of tax is 40, we mean that 60% of it is the profit अगर 100 रुपीज हम अर्न कर रहे हैं, 40 रुपीज या 40 पैसा और 40% उसमें से टैक्स पे कर रहे हैं, तो व्हाट इज द प्रॉफिट? 60% और 60 पैसा. आई रिपीट, इफ our earning is 100, 40% or 40 paisa we are giving as a tax, so 100 minus 40 is equal to 60 is our profit. Therefore, if this is given 40% as tax rate, then how much profit we are left with? We are left with 60%. If profit is 60%, if profit is 60%, then in terms of rupees, how much we are getting? 6 lakh. This is after paying tax. We want before tax 100%. So then, if profit is 100%, then we have to do cross multiplication. Therefore, it will be 6 lakh multiplied by 100 divided by 60 is equal to 10 lakh. This 10 lakh is the value of profit before taxes. Next is we have to add interest into it. Debentures are issued on 12% interest. This is interest rate of debentures. Debentures के principals की value है 40 lakh. उस पे हमने debenture holders को interest दिया 12%. Therefore, interest हमारा फिक्स्ड इंटरेस्ट की क्या वैल्यू है? फिक्स्ड इंटरेस्ट इज इक्वल टू 12% ऑफ 40 lakh. 12% of 40 lakh will be 4,80,000. This is the amount of interest we have paid to the debenture holders. Our title is EBIT, मीन्स इसमें टैक्स भी ऐड करो और इंटरेस्ट भी ऐड करो. टैक्स ऐड करके हमारा प्रॉफिट बन गया 10 लाख. इसमें इंटरेस्ट वी नीड टू ऐड एंड वी विल गेट आवर टाइटल EBIT. Therefore, EBIT is 10 lakh plus 4,80,000. This is equal to 14,80,000. This is the value of EBIT. Substitute it into the formula. So it is ICR is equal to earnings before interest and tax 14,80,000 divided by fixed interest. This fixed interest 4,80,000 with 4,80,000. So by dividing 4 times 3 is 12. It will come 3.08 times. Answer has to be in terms of times. See again, your formula is EBIT, means वो प्रॉफिट लेना है जिसमें इंटरेस्ट और टैक्स माइनस नहीं हो. बट इन क्वेश्चन वी आर गिवन नेट प्रॉफिट आफ्टर इंटरेस्ट एंड टैक्स. तो स्टेप नंबर 1 में हम सबसे पहले इसमें टैक्स ऐड करेंगे, फिर उस प्रॉफिट में इंटरेस्ट ऐड करेंगे, देन वी विल बी अराइविंग एट द फिगर ऑफ EBIT. हाउ इट इज डन? अगर आपके क्वेश्चन में 40% टैक्स है तो दैट मींस आपका प्रॉफिट बचेगा कितना? 60%, बिकॉज टोटल इज 100%. इफ टैक्स इज गिवन 30% तो जो प्रॉफिट बचेगा दैट इज 70%. इफ टैक्स रेट इज 25%, प्रॉफिट लेफ्ट इज 75%. Apply the here proportionate formula. If profit is 60%, 100 में से 40% टैक्स माइनस कर लिया, बच गया 60%. और रुपीस में कितना है? 6 लाख. हमें कितना चाहिए? बिफोर टैक्स मींस 100%. Therefore 100% क्रॉस मल्टीप्लाई, दिस इज द वैल्यू ऑफ प्रॉफिट बिफोर टैक्सेस. अब इसमें इंटरेस्ट वैल्यू ऐड करेंगे. दिस इज द फिक्स्ड इंटरेस्ट कंपोनेंट, ऐड इट बैक एंड देन you will substitute it in a formula. This is how we calculate all the solvency ratios.